In this video, we're going to look at Nutrien. And Nutrien is a Canadian fertilizer company. And they trade on the New York Stock Exchange and the Toronto Stock Exchange. But this video is on the New York Stock Exchange since the company reports its financials in US dollars. What I do in my videos is I try to figure out the value of the company's stock using prior financial information. I also look at the financial ratios of the company. Let's get started with the model. This company has a market cap of $18.46 billion. And they're trading at $32.56. And next we need the free cash flows. And free cash flows is how you value a company. That's the cash that's left over after paying your expenses. So what you do is you estimate the future free cash flows and then discount that number back to today's value. We also need their net income, which is the profit and loss on the income statement. And then the revenue, which is also on the income statement. This is the sales for each year. And you can see they had a nice pop in revenue from 2017 to 2018. So that's a really good sign that they're growing. Let's figure out the capital structure of the company to figure out what discount rate to apply to the future cash flows. So they pay interest expense of $559 million. That's interest they pay in their debt, and that's on the income statement. Let's go to the balance sheet to figure out how much debt they have. We'll go to the liabilities section. And current liabilities shows the current debt of $1.5 billion. That's debt due within 12 months. Under non-current liabilities, there's a long-term debt of $8.5 billion. That's debt due after 12 months. Since interest payments are tax deductible, let's get their effective tax rate. The income before tax is $1.3 billion. And also on the income statement, their income tax is $316 million. So the cost of debt is 4.23%. And to get the cost of equity, we need the beta. That's the volatility of the stock. And their beta is 0.67. So their stock moves less than the market. So that's a good sign because that means the weighted average cost of capital will be lower with a low beta. We need some more information for the financial ratios. We got to get their current assets. And these are mainly assets that consist of cash, accounts receivables, and inventory. And that's $10.5 billion. And current liabilities, these are debts and payables that are due within 12 months, and that's $9 billion. Their equity is the total value of the company, that's $22.9 billion. That's assets minus liabilities. And their EBIT, earnings before interest and taxes, that's called operating income on the income statement. That's $2 billion. That's how much money the company makes from operating its business, but before paying interest and taxes. So to get the weighted average cost of capital, it's a blend of the cost of debt and the cost of equity. And the cost of debt is 4.23%, and they have 30% debt in their capital structure. The cost of equity is 7.47%, and we use the capital asset pricing model to figure that out. And they have 70% of equity in the capital structure. So the weighted average cost of capital is a combination of those two numbers, 6.48%, and that's what we're going to use to discount the future cash flows. So we estimated 4 years of future free cash flows. We did a terminal value, which is all years past year 4. Then we discounted those numbers back to today using the weighted average cost of capital, and we get a value of the company of $39 billion. We divide that by 567 million shares, and we get an intrinsic stock price of $69. It's trading at $33, so it's trading at a 53% discount. So it's a buy according to the model. So let's see what Simply Wall Street values the company at. They value them at 6701, almost exactly what I value them at. So both of our models say the company is a buy. Let's see where it was trading at the past few years. So it was trading in the 50s and might have even touched the 60s a few years back, but it's come down a bit. I'm kind of surprised since their sales have been through the roof. But maybe this has room to grow, and maybe there's a lot of pessimism in the market about this company or about the industry. Let's look at their financial ratios. They have a PE of 18.6, which is okay. That's price of stock over earnings per share. They have a really good price to sales ratio of 0.9. That's price of stock over sales per share. But they're not doing a good job of converting those sales into income. I'll show you their net income margins, which is net income over revenue. In 2016 and 17, it was 7%. But when their sales jumped up to 19 billion, the net income margin jumped up to 18%, so they converted a lot of that revenue into net income. As you can see, the net income went up from 327 million to 3.6 billion. But in 2019, it's at the worst levels. It's at 5% net income margin, so they only converted 5% of their revenue into net income. So price of sales is good if it's low, but it doesn't indicate whether the company can convert that into net income, which is really important. They have a good price to book of 0.8. That's price to stock over book value per share. Under 1 indicates it's a really good value. 1.2 current ratio, so they can cover their current assets. 4% ROE because their net income is so low, so they don't have a good ROE. They have a good interest coverage ratio. They can cover their interest payment almost 4 times. And they're doing well in debt, only 30% debt. So it looks like a good company with a good future. Let me know what you think in the comments. Thanks for watching.